Emami in its quarterly result continued to witness a moderate sales growth due to muted volume growth. Let's do a three-point analysis of the Q1 earnings fine print and the outlook on the company. 1. What were the key result highlights in Q1? Well, consolidated sales for Emami grew by 5.6% year-on-year in Q1, wherein key drag has been the domestic sales with flattish volume growth. Rural sales growth has been a key laggard with 1% growth for the quarter, while the urban sales growth was about 2.5%. Now, in terms of other product categories, major drag have been the healthcare range as well as the male grooming range. Now, key positive for the quarter has been strong performance by Kesh King range, which showed 30% growth year-on-year. Now, company's market share in premium oil category is 26%. Additionally, international business grew 34% in Q1. Further, while gross margins have contracted, EBITDA margin improved by 108 basis points year-on-year as higher employee costs was offset by moderate increase in other expenses and lower advertising spend. 2. What were the key observations? Well, in the last 4 quarters, company has underperformed the median sectoral performance due to adverse seasonality and a skewed exposure to rural demand. In light of the macro headwinds, company has restrained itself from higher promotional expense and has also slowed down the pace of product launches. Now, key non-operational risk for the company remains the overhang of promoters' pledge. Now, the management expects significant reduction on pledge holding in the next 6 to 9 months. While in recent past promoters have actually worked towards reducing the pledge amount, it still is high at 3,500 crore rupees compared to the market cap of over 14,000 crores. Now, promoters' shareholding has also come down from 73% in December 2018 to 53% in June filing, while pursuing the reduction of pledge holding. 3. What's the outlook on the company? Well, management's growth expectations for FY20 has actually come down from 12 to 14% to now 9 to 10%. Major part of growth outlook is also hinged on the rural demand revival. Slowing down of product launches and advertising spend is quite prudent, and as this should also be supportive for the margins in near term. Further, raw material prices are also in a downtrend. Now, in the coming days, we also look for a broad-based improvement in growth before getting more constructive. Having said that, the steep valuation discount is also quite impressive. Stock is currently trading around 23 times its FY21 expected earnings, and that warrants attention from the investors.